Most people don't lose money in crypto because crypto is a scam. They lose money because they don't understand the game they're playing. And here's the uncomfortable truth. The market is not designed for beginners to win. It is designed to transfer money from the impatient to the disciplined. In this video, I'm going to explain why most traders fail, what actually causes losses, and how to position yourself differently. They trade emotion, not structure. The number one reason traders lose money is emotional decision-making. They buy because a coin is trending. A YouTuber said it's about to explode. They see green candles. They sell because price drops 5%. Fear kicks in. Twitter turns negative, but markets don't reward emotion. Markets reward structure. Professional traders operate with defined entry plans, defined exit plans, defined risk levels. Retail traders operate with hope, fear, impulse, and that difference alone explains most losses. They don't understand risk. Most people focus on potential profit. Almost no one focuses on downside protection. They ask, how much can this go up? Instead of, how much can I afford to lose? This is backwards thinking. Smart traders calculate position size, stop-loss distance, risk per trade, often 1 to 2%. Most losing traders go all in, over-leverage, average down blindly. Risk mismanagement destroys accounts faster than bad picks. They confuse investing with trading. This one is subtle and dangerous. Investing, long-term thesis, fundamental belief, time horizon measured in years. Trading, short-term price movement, technical levels, time horizon measured in days or weeks. Many people buy a coin as a long-term investment, then panic sell it 2 weeks later. Or worse, they trade short-term while telling themselves they're investing. That identity confusion causes emotional chaos. You must decide, are you an investor or are you a trader? Because the strategy for each is completely different. They follow noise instead of data. Crypto moves fast. News spreads instantly. Rumors spread even faster. Most traders scroll constantly, react constantly, change positions constantly, but the best traders often do less. They focus on liquidity zones, market structure, volume, macro trends. They ignore most noise. The market rewards patience. Now here's where this gets interesting, because once you understand why most traders lose, you can flip the structure in your favor. In the next section, I'll show you the mindset shift that separates consistent winners from constant losers. Winners think in probabilities, not certainty. Most losing traders want certainty. They want to know. Is this going up? Is this the bottom? Will this 10x? But markets don't offer certainty. They offer probabilities. Professional traders ask, what's the likelihood? What's the risk to reward? If I'm wrong, how small is the damage? Instead of needing to be right, they build systems where even being wrong doesn't destroy them. That shift, from prediction to probability, changes everything. You don't need to win every trade. You need a system where wins are larger than losses. Traders define risk before entering. Before entering a trade, disciplined traders answer 3 questions. Where am I wrong? How much will I lose if I'm wrong? Is the reward worth that risk? If you can't answer those 3 questions, you shouldn't be in the trade. Simple. One practical rule many professionals use: risk 1 to 2% of total capital per trade. That way, even 5 losing trades in a row doesn't destroy you. Most retail traders risk 20%, 50%, sometimes 100% on one idea. That's not trading, that's gambling, and gambling eventually catches up. Traders wait for confirmation. Impatience is expensive. Many traders enter because it looks like it might break out, but experienced traders wait for confirmed structure break, confirmed volume expansion, confirmed higher highs. Yes, this means entering slightly later, but it dramatically reduces false signals. Most beginners want to catch the exact bottom. Professionals are comfortable catching the middle of the move, because the middle is where probability lives. Traders have a repeatable framework. This is the biggest difference. Losing traders trade randomly. Winning traders operate from a framework. A framework might include only trade with trend, only trade after pullbacks, only trade during high volume, only risk fixed percentages, only take 2 to 3 setups repeatedly. Notice something. They don't trade everything. They trade a small edge over and over with discipline. That repetition builds consistency. Consistency builds capital. Capital builds freedom. In closing things up here, so if 90% of traders lose money, it's not because crypto is impossible. It's because most people enter without structure. If you flip that, if you build rules, risk control, and patience, you automatically move yourself out of the 90%. Final resolution: the real edge. Let me leave you with something important. Crypto is not a lottery ticket. It's not a shortcut, and it's definitely not a game where emotion wins. The market doesn't care about your conviction, your excitement, your fear, your last loss. It only responds to structure. And the truth is, if you simply manage risk, define entries, define exits, and trade with patience, you are already operating differently than most participants. You don't need secret indicators. You don't need inside information. You don't need to catch every move. You need discipline, and discipline compounds faster than hype. Most people approach crypto trying to be right. Professionals approach crypto trying to be consistent. Right is emotional. Consistent is mathematical. If you focus on consistency, you don't need to win big. You just need to survive long enough for probabilities to work in your favor, and that alone moves you out of the 90%. If this helped clarify how the market actually works, subscribe. Because on this channel, we're not chasing hype. We're building frameworks.